Silver has never been allowed to find price discovery because 8 banks in the West have stepped on it forever to make high-tech weapons cheap. That is my belief. Not even cheap, available in abundance, because silver's disappearing in nature, called inelastic. There's only a little bit of silver in a high-tech military component, weapons, F-35 stealth bombers, high-tech missiles that are hypersonic, and nothing can withstand that heat and still have conductivity the way silver does, and it's needed in all of this stuff. And this is why you have these banks in the West, Canada, US, and Europe, have stepped on silver so they can make high-tech weapons and sell them to the world through NATO, become very wealthy. I think silver is still, from a standpoint of low downside, high upside, I don't think there's an asset that competes with it. But at today's silver price, that's over $4 billion. They imported 365 tons of gold in Q1 2026 alone as the price was getting kneecapped. A new all-time record, 35.2 billion in physical gold delivered in a single month to Comex in the United States. No one's talking about this but me. Where's the mainstream? We see Chinese silver imports rise 78% month over month in February and March to a record 1,626 tons. That's the highest on record ever. The deliveries in February was an all-time record. In March was another all-time record. The highest delivery numbers ever into China since they've been keeping records, ever, as the price was getting destroyed. Their year-to-date silver imports are up to 1,626 tons, times 32,150.7 ounces in a metric ton is 52,276,939 troy ounces. At today's silver price, that's over $4 billion. That's just in the first 90 days of the year as the price was getting slammed. They're net importers this year. They were net exporters last year. They are net importers. They said in November of last year that they would not send any of their domestic mining silver out into the open market. They're the second largest producer in the world. They said they're going to minimize the amount or curtail the amount of exports they're going to do. They refined more doré bar than anyone, and they came out and said we're going to limit the amount of sulfuric acid we're going to export, which is the main chemical used in copper mining, which is the major byproduct mining material for silver. Silver, only 20% of what was mined came from mining companies who mined silver. The rest was byproduct largely of copper, lead, and zinc, but copper mostly. And if you curtail exports, you're not going to send any of your domestic stuff out, and you are going to curtail sulfuric acid. They're the biggest producer of that.
China just bought record amounts of silver while prices were collapsing, and that contradiction should terrify anyone trusting headline pricing. As Andy Schectman points out here, over 52 million ounces flowed into China in just 90 days, while Beijing simultaneously restricted exports and tightened supply chains tied to silver production. That is not panic buying. It is strategic accumulation during engineered weakness. Retail investors see red candles and hesitate, but sovereign buyers are securing physical metal before shortages become obvious. Next, Andy Schectman exposes why suppressing sulfuric acid exports may matter more than the silver price itself.
You're going to have a problem with supply, but that's silver. Gold, 162 tons in March. That's the highest since March 24. Marks the third consecutive monthly increase, 17th consecutive monthly purchase. They imported 365 tons of gold in Q1 2026 alone as the price was getting kneecapped. 365 metric tons works out to 11,735,055 ounces. At today's price, that's $54 billion in the first 90 days as the price was getting hammered. Now let's look at here back at the ranch in the United States. First of all, in 2025, every single Comex gold contract delivery month in 2025, and those are the even months, they would be February, May, July, etc. We saw 76,567 gold contracts delivered. That's 7,656,700 ounces, a new all-time record. A new all-time record. 35.2 billion in physical gold delivered in a single month to Comex in the United States. No one's talking about this but me. Where's the mainstream? All of this as gold's teeth was getting kicked in. And to put that into perspective, If you go back to 2015 to 2019, we averaged, this is right when I started screaming about all the deliveries in 2020. That's when they started. From 2015 to 2019, only 130 tons of gold were delivered into Comex on average per year. February of this year saw 238 tons delivered alone. So when you look at silver in the month of February, which is a non-delivery month, on Comex, 26 million ounces were delivered. Now, keep in mind, for the last 18 months or longer, every month, every single month since he won the election, we've seen billions of gold and silver delivered into Comex. Again, less than 1% used to stand for delivery.
Comex deliveries just shattered records at the exact moment mainstream analysts said demand was weakening. According to Andy Schectman, February alone saw more gold delivered than entire pre-2020 annual averages, even as prices were pushed lower through paper markets. Institutions are clearly treating price declines as acquisition windows, not warning signs. The dangerous part for ordinary savers is that physical delivery trends now completely contradict the gold is losing momentum narrative dominating financial television. Next, Andy Schectman reveals the hidden implication behind billions in physical metal quietly leaving exchange inventories.
Now we're seeing all this, and don't tell. Where's the media? Where the hell are they? Where are they saying, who's doing this? They don't ask. They've missed the story completely. Nothing else matters. The people doing this do not screw around. The people doing this are spending billions of dollars. So in February, which is a non-delivery month, we saw a record for China in both gold and silver. We see record gold delivery on Comex. How about in silver, which is a non-delivery month? Remember, January is, February is not, March is, April is not, May is, etc. December, they both deliver together. But anyways, 26 million ounces delivered to Comex. At the time, that's about 1.4 billion. However, 39 million ounces leave Comex on trucks. Where did they go? That's 2.8 million pounds of silver. That's worth, call it 40 million times. So you're talking almost $3.5 billion worth of silver got on semi-trucks, 2.8 million pounds, and left. Where's the media coverage? Who is taking possession of 2.8 million pounds of silver? Who's running logistics for that? How many semi-trucks? Who's putting insurance on it? Where in God's green earth is it going? What I would say to you, and I say this a lot lately because I think it hammers home the point, I see Wayne Gretzky when I play golf sometimes at Trump International in West Palm Beach. He's a small guy. He plays at Trump all the time. He's not a big guy. I'm bigger than him. They said, how are you such a great hockey player, Wayne? Because he said, I never skate to where the puck is. I skate to where it's going.
Nearly 40 million ounces of silver reportedly left Comex vaults by truck, yet financial media barely mentioned it. What Andy Schectman is highlighting is the absurd disconnect between physical movement and public narrative. Because logistics at this scale require insurance, transport coordination, and institutional intent measured in billions. That is not speculative retail behavior. If major entities are removing physical metal during suppressed pricing, then the official healthy and liquid market story begins falling apart very quickly for anyone paying attention. Next, Andy Schectman unravels why physical withdrawals matter far more than daily spot price volatility.
And I will tell you that the people at this level that are spending 9 figures every month for almost 2 straight years, they know where the puck is going. They do not screw around. You do not dump billions and billions and billions every month into delivery of metal, which never happened. Now, granted, when it's delivered to Comex doesn't mean it's all leaving. That doesn't matter because we never saw this kind of volume being delivered into Comex. Never. We've never seen this kind of volume being delivered to China. Never. And so what you have happening is price is the tool of misdirection that they use. Price and rhetoric. The rhetoric, there is none. The media sucks. The media doesn't tell us what's really relevant. They talk about the price or the technicals, usually anti-gold in slant, but they miss the entire story. It doesn't matter what the price. Who's standing for delivery irrespective of price? Price gets knocked down and they stand for delivery in massive quantities. Now, the Bank of International Settlements came out and said this was a structural collapse in January and February. It was completely, largely by the rebalancing of the ETFs and the raising of margin requirements. It had nothing to do with fundamentals. Well, as the price got destroyed, you can see what happens by the most well-informed traders on the planet who aren't using margin. Thank you very much. I'll have some more, but don't tell anyone. And that to me is all the gold people need to know, is that the people at this level know where the puck is going and do as they do. Don't listen to any anti-gold rhetoric right now. This is the time, I think, that gold and silver are about ready to really make a move.
The biggest money in the world keeps increasing physical metal deliveries, while public sentiment stays cautious, and timing like that rarely happens by accident. Andy Schectman's argument suggests institutional buyers already see a structural shift forming beneath the surface of the paper market. The BIS blamed ETF rebalancing and margin changes, but that explanation ignores the relentless appetite for physical possession during aggressive price suppression. Investors focused only on charts may completely miss the far more important signal hidden in delivery behavior and sovereign accumulation patterns. Next, Andy Schectman reveals why the smart money appears willing to absorb volatility before the public notices the trend reversal.
Not only do you have all the major banks talking between 6,000 and 8,000 by the end of the year, you have Michael Hartnett, the chief analyst for the chief analyst for Bank of America. You have the chief investment officer of Morgan Stanley. You have BlackRock. You have Jeffrey Gundlach. You got all these institutions saying that gold and silver are going way higher, and that the 60-40 bond portfolio, stock bond portfolio mix that Wall Street has used for 50 years is dead. And all of these, Michael Hartnett, Jeffrey Gundlach, the CIO of Morgan Stanley, they're all saying sell some of your bonds to buy metals. This has never happened before. My guess is they want gold to go to the moon. The U.S. government ultimately does, to devalue the dollar, to peg it to the back end of the bond market, if Judy Shelton is right, for long-term deliveries into bonds. With the Genius Act coming, this is how you devalue the dollar. This is how you let gold go higher, to devalue the dollar, to bring back manufacturing and to peg it to the back end of the bond market. I've never been more bullish in gold and silver ever. I think it's also a very difficult time to have strong fingertips. The bull wants to bring as few along for the ride as possible. But I think all you need to see is the betrayal of the rhetoric and the price drop when the biggest money in the world uses it as an opportunity to get long and to take possession.
Great points, Andy. Thank you so much for that. With that being said, do you see a scenario where gold and silver stay flat for relatively longer, let's say for 6 to 12 months, just because of how fast price went up last time?
Wall Street spent decades selling the 60-40 portfolio as safe, yet now the same institutions are quietly abandoning it. This is where Andy Schectman's thesis shifts from commodity speculation into systemic currency risk. Because when major banks openly recommend rotating from bonds into metals, they are signaling declining confidence in fiat purchasing power itself. Most retirees and savers are still positioned for the last economic cycle, not the next one forming underneath it. The danger is not volatility, it is holding assets designed for a world that no longer exists. Next, Andy Schectman exposes why dollar devaluation may already be the policy objective behind the scenes.
So there could be some more digestion before the next move?
I don't, actually. I mean, that is conventional wisdom, is that we've seen that in the charts where it goes up, it corrects, it trades sideways, base builds goes up, corrects, goes sideways. We have been going sideways. I think we've been going sideways now for a couple of months. Gold is hanging in there anyway, and I think we're getting very close to that moment. All of the analysts are saying second half of this year. Bank of America is saying between 130 and 309 gold potentially by the end of this year. I think that things will certainly start to accelerate into the end of the year. Now, I don't think today is any example of that, but here we are. I know this might go out a little bit later, but here we are today with gold up $130 and silver up $4.50. That's a pretty substantial move. Now, the volatility is what keeps people at bay. But the price continues to move higher with a great deal of volatility, largely treading sideways, I agree. but I think we are very close to breaking out of that pattern. There are a lot of things converging all at once, and I would say, if I had to guess, now I normally don't make predictions on price or even really time frame, because I think that we live in a world of probabilities, no guarantees. It is highly probable we see gold and silver much higher into the end of the year, no guarantee, but I don't see it as being likely that it trades sideways for an extended period of time based upon the amount of deliveries we continue to see, which betrays any price action.
Gold just surged $130 in a single move after months of sideways frustration. And historically, that kind of compression rarely resolves quietly. Andy Schectman notes that physical deliveries continue accelerating underneath the surface even while price action appears stagnant, which suggests institutions may already be positioning ahead of a larger repricing event. Retail traders often mistake consolidation for weakness because they focus on momentum instead of accumulation. Meanwhile, central banks and large funds appear willing to absorb volatility, now in exchange for strategic exposure, before confidence in paper assets deteriorates further. Next, Andy Schectman reveals why the seasonal timing of metals markets could align with a broader institutional rotation.
So no, I don't. I think it's going to be a interesting, as the Chinese curse says, second half to the year. And typically the metal market wakes up over Labor Day. I mean, from September on is traditionally when you see the biggest moves in gold and silver. So yeah, I would say that the sideways, if at all, will go into the end of August at worst. And then I think we would see some fireworks, if I had to guess.
Just a question on silver, Andy. So do you think silver at this moment is mainly driven by the industrial side, or do you still believe the monetary side is important for silver?
The monetary side has always been important, but it's never been what has driven it. Silver has been driven by the accumulation by the biggest money in the world. China, India, Russia, Saudi Arabia, now the United States, who's classified as a critical mineral. Silver is a critical mineral. It has great plurality in uses, which, to your point, is unusual in commodities, where it has the monetary side and the industrial side and the military side, and it's needed in any digital, electronic, high-tech world, especially one with high-tech weaponry. This is why you've had 8 commercial banks in the West hold down silver for years, to the degree of the largest concentrated short position in any commodity ever traded. I don't care what anybody says. Nobody. How smart they are. Silver has never been allowed to find price discovery because 8 banks in the West have stepped on it forever to make high-tech weapons cheap. That is my belief. Not even cheap, available in abundance, because silver is disappearing in nature. It's called inelastic.
Silver is now classified as a critical mineral by the United States, yet most investors still view it as a fringe trade rather than a strategic asset. According to Andy Schectman, sovereign accumulation, not retail demand, has been the real driver underneath the market for years, especially as military and technological dependence on silver quietly expands. That creates a dangerous disconnect between public pricing and geopolitical importance. If supply remains constrained, while governments increasingly treat silver as essential infrastructure, long-term holders may be sitting on an asset Wall Street still fundamentally misunderstands. Next, Andy Schectman points out why decades of silver suppression may have been tied directly to defense and industrial policy.
There's only a little bit of silver in a high-tech military component, weapons, F-35 stealth bombers, high-tech missiles that are hypersonic, and nothing can withstand that heat and still be have conductivity the way silver does. And it's needed in all of this stuff. And this is why you have these banks in the West, Canada, US, and Europe, have stepped on silver so they can make high-tech weapons and sell them to the world through NATO, become very wealthy. I think silver is still, from a standpoint of low downside, high upside. I don't think there's an asset that competes with it, but the monetary side of it, the public, is the last one to have anything to do with driving the price up. Maybe that will happen in the end, Right now, it's been a rush to accumulate, using the suppression of the Western markets to stand for delivery. And the fact that the U.S. government classified silver now a critical mineral is probably who is behind, through the Exchange Stabilization Fund, the Treasury Department, Besant, who understands metals. He was a gold bug when he ran his hedge fund. If it is for national security, they don't need congressional approval. Well, who's standing for delivery and pulling 39 million ounces out in February by truck? Where's it going? Who's doing it? Who's got that bread? Who's running the logistics and the insurance, and what vault is it going into? Because when you pull those bars out of Comex, they're never coming back. They'd have to be drilled and filled again and assayed, and at a big cost, a huge time drag. They're leaving, they're never coming back. So I think the biggest money in the world sees silver for what it is: indispensable. It's not replaceable. And there is the monetary side too, which will be kind of the supercharge at the end. But I would argue it's had very little impact, more so the central banks accumulating what is available, the big money accumulating it, for the fact that there's nothing that can really be used as a substitute.
Governments publicly frame silver as just another commodity, while simultaneously classifying it as strategically critical for advanced weapon systems. What Andy Schectman is highlighting is a contradiction few analysts are willing to touch. If silver is indispensable for military infrastructure, then persistent price suppression may have served national and industrial interests far more than free market price discovery. Physical withdrawals from Comex become much more important through that lens, because once sovereign level buyers secure supply, those ounces likely never return to circulation.